Good morning, everyone. So today podcast will discuss will a recession crash home prices? What every buyer and seller must know. So basically, good morning, the Nadlan family. This is your host, Leo Lustig, coming at you with the latest and greatest from the US real estate world. Today, hot topic, could a recession lead to lower home prices? Or are we just dreaming between mortgage payments? Just daydreaming. Let's dive in. All right. So first of all, the big question. So here's what everyone buzzing about: a possible U.S. recession in 2025. Historically, recessions can lead to lower home prices because people spend less. Job losses pile up, and buying a home suddenly feels like buying a yacht. But, and this is a big but, it's not always that simple. So what makes 2025 different? Today's market is tighter than a lid on a pickle jar. Inventory is super low, and homeowners are chilling with those sweet low mortgages rates they locked in during the last few years. No one rushing to sell, meaning supply is squeezed, and that keeps prices sticky even when demand drops a bit. So, before we are going to jump into this topic, I want to join all of you into our community, join our podcast on YouTube. You have many episodes. Of course, like and subscribe. Join our website, daily news in 109 languages. And of course, our social network. We have currently 261 chat groups. You can talk to different experts. You can see updates about financing, updates about every state. There's also premium members, specific content. You can jump into every state, and we update every day data about that state. And of course, you can always see all of the latest trends and updates. For example, now in New York, you will be able to fly without even showing a passport. You can see a lot of experts' stories and a lot of news. You can also consume all of that on our app for Android and Apple. And let's take a look. Currently, we have almost 23,000 members on our social network. Let's see how the USTs did today to determine the rates. All right, so we see that the 10-year treasuries went up a bit. And the mortgage rates are the lowest they've been for the last 3 weeks. We can see rates just a bit below 7%. The economic data for today, you can see that today there's nothing specifically scheduled. Tomorrow, we're going to see the advanced US trade balance in goods, wholesale inventories, S&P Case-Shiller Home Prices Index, consumer confidence, job opening, employment, GDP, employment cost index. We're going to have the PCE index. So expect fluctuation. A lot of companies report this week. And we can see, as for the latest mortgage updates, existing home sales are at 5-month low. New home sales running near highest pace since 2022. We can see that today the stock market basically opens flat. There's no much change in the S&P, the Nasdaq, and the Dow. And the US 10 years Treasury We can see that it's going up a bit. And basically, this is the topic for today, an article that we posted on our website. Could a recession lead to lower home prices? Understanding the potential impact of the housing market. So basically, a comprehensive analysis of current market conditions and potential recession impacts on real estate, essential insight for investors and homeowners navigating the 2025 housing landscape. So first of all, let's do some deep dive. So this is a special podcast episode about everything that's going in the market, in the mortgage industry, and in the real estate industry in the US. We're going to do a deep dive into current condition and recession impacts, regional insights, exploring the market variations across different cities, expert recommendation, actionable advice for navigating uncertain markets. I'm your host, Lior Lustig. Today is April 28th. Of course, like and subscribe, grab your coffee. And today's biggest question, could the recession finally crash home prices? So today, current mortgage landscape, we can see a 6.86% for the 30 years fixed, 6.14 for 15 years fixed, and 6.16 for 5-1 arm. So there were modest trend changes that hit at bigger market moves ahead. Financial signals suggest volatility in coming months. So recessions and real estate, historical perspective that we can basically see. 2008, we had the Great Recession. Home prices crashed dramatically by 30%. 2001, tech bubble. Surprisingly, home prices actually rose during this period. And in 2020, COVID crash, brief dip followed by unprecedented growth in prices. So not all economic downturns impact real estate equally. Each recession has unique effect on the housing market. And so what are the potential outcomes? If a recession does hit, yes, some buyers might get cold feet, delaying purchases until they feel secure. That would reduce demand. But with so few homes for sale, don't expect a big price crash unless job losses skyrocket and foreclosure spikes. The market likely won't nosedive. All right. So what is today unique market condition? So basically there is limited inventory. Housing supply remains constrained across most markets. Fewer listings mean continued competition. Millennial demand, larger buyer demographic in history continues driving persistent demand despite economic concerns. Restricted development, builders have reduced new construction project, supply constraints will likely persist for years. So what is the expert consensus? Without massive inventory increase, expect slow growth rather than a market crash. So basically, economists say expect a cooling market, not a crashing one. The balance between fewer buyers and even fewer sellers will be key. Plus, watch mortgage rates. If they drop because the Fed reacts to the recession, buying might get a lot more attractive again. So we saw all of the competition, all of the debates between Donald Trump and the Fed, Jerome Powell. Jerome Powell basically, as long as we are in uncertainty waters with the tariffs, until we're going to know what the tariffs are, basically tariffs are inflationary. So basically we are going to see a spike in prices in the US, especially that we don't see any continuation in the talks with China, even though Trump mentioned that a few times that there are talks, but the Chinese people said there's nothing, there's no talks. So basically, these are developments that we will need to look at. All right, so what are the key market indicators to monitor? So first of all, of course, the mortgage rates. The Fed policy shift could push rates down to 5.5% by early 2026. All right, so this is what we might see with the rates. We also need to remember that rates became less and less dependent on the Fed. For example, here in February, we saw basically a rate decrease by the Fed of 0.5%, but the actual rates jumped because basically today the treasuries are acting independently based on market assumptions. So here in April, when we expected that they're going to be lowering rates by the Fed, the rate already dropped from 8.5 to 7 here at the bottom, and then basically jumped to around 7.5, 8 right here, even after the rates were basically lowered. All right. So inventory fluctuations. Of course, we need to remember that there are 50 states, and each state's is basically acts independently. Just Texas is, like the Dallas Fort Worth and Austin and Houston. They all act differently. So sudden listing increases. How can we see an increase in listings? Basically, a lot of potential sellers are not going to sell their house because they locked very low rates. Once we're going to see the rates drop, let's say to 5.5, it's going to be much closer to the rates that they locked, let's say 3.5 or 4.5. So they might say, all right, we want to improve our living, we want to move to a bigger house, a lot of people that work from home and stuff like that. Currently, they don't want to let go their houses. And we see different markets, for example, in Florida, Cape Coral and stuff, that builders were overbuilding. So we see an increase in inventory in certain markets. And on the other side, some markets are already actually contracting and there's not enough inventory. So we need to watch the monthly supply metrics. And of course, look at distress signals. Luxury markets and short-term rental areas show problem first. So if we see luxury houses going down and short-term rentals that are not being filled up, these are early signs of a recession. They serve as early warning systems. All right, so regional market variations. So basically, we are having the high-risk markets. Austin, Boise, and Phoenix face potential of 10 to 15% correction. Austin was number one market during COVID. We saw a lot of inflow of population. We can look at this market. Reventure App is one of the apps that are available for you in the premium membership. So let's look at Austin. And we can see that prices are going way down. All right. 50 is a stable market. We are at 32. All right. So we can see that as for inventory, we have an increase of 73% in the inventory. Days on market are currently 52. Let's see, it compares year over year. So days on market actually lowered by 16%. Median listing price So went down 16% from 860s to 750. So whoever bought at the top now feeling the pain, but it means that more property is going to come in the market, and new listing count actually decreased by 26%. And let's see the demographic population growth. So we have 17% mortgage inflow of population growth, and the rent as compared to the income. So basically, the median income is 160,000, very high, and the cost of rent is about 19% of that. So these are actually good numbers. All right. So what are the stable markets? Dallas, Tampa, and Midwest regions show continued resilience. All right. Let's look, for example, at Dallas. All right. So we can see that Dallas is more or less stable. The prices are stable. It really depends per zip code. And let's look at Tampa. Yeah, we can see that some areas of Tampa prices are actually going down. Yeah, because also Tampa, for example, used to be one of the hottest markets, Tampa, Orlando, and Jacksonville. And surprise, surprise, we are building in Ocala, which is right here. So let me show you something. Just 1 second. So basically, you can see this year we just have three at the top. Ocala jumped to number 2, second most popular. So Ocala, where we build, became number 2 in the US, basically because all of the surrounding areas became way too expensive, right? So you can see that people still like to move to Florida, all right, but they just move to a cheaper market around, all right. So we actually see an outflow from Tampa, prices getting lowered because simply it became too expensive. All of these markets became too expensive, so people are moving closer to Ocala, where prices are still stable. Supply constrained areas, markets with limited development capacity maintain price stability, and job growth centers. So we need to basically follow all of the updates with companies that are coming to the US to build. For example, Taiwan Semiconductors, they are now building in Indiana a new chip plant. And actually, Intel are going to outsource some of their chips to Taiwan Semiconductors. Apple mentioned that they are going to develop factories and develop basically for $500 billion. And Eli Lilly and many other companies that want to prevent the tariffs, so are going to manufacture in the US. So basically, you need to follow all of the job growth centers. All right. So let's see our advice for current investment. All right. So basically, perfect timing is a myth. Market timing is impossible to perfect. Focus on fundamentals instead. So, like we are teaching in our courses, you need to know the fundamentals. When we saw so many investors that are basically not following the fundamentals and going with the hype, forget to check, all of the major S&P companies that are in your investment location, the population growth, jobs, crime, and schools, everything that attracts new buyers, and also movement. You can even check the movement of U-Haul and other moving companies where people are actually moving. So smart buying principles: good properties in strong location retain value regardless of cycles. So if you're buying properties in good locations where there's not too many investors, so basically home buyers actually own the property. So always look at the percentage of home buyers as part of their population. Rate strategy: marry the house, date the rate. This is what I always say. Refinancing remains an option later. So you can buy the house now, even if the rate is a bit higher, but you can refinance later. Don't wait for the fairy tale pricing that may never materialize. Quality investment perform well across market cycles. And we can see the market snapshot as of future supply. We can see that Zillow stock price is currently $66. So basically, by looking at the stock prices, we can see how well builders are doing. Home builders remain cautious about future projects. Restricted development means higher prices will persist longer term despite economic headwinds. So basically, we can see Zillow listing policy shift. We're going to discuss about it in the next podcast. But basically, as for the topic of today, recession impacts on housing prices. As discussion about a possible US recession in 2025 intensify, many wonder how much an economic downturn might influence on prices. Historical patterns show varied effects, with the current market presenting unique complexities. All right. So, first of all, economic impact. Recessions typically decrease consumer spending. So, in recession, basically, consumers are spending less, they are buying less goods, and there might be an increase in unemployment. When more people are unemployed, they can't be approved for Freddie Mac, Fannie Mae mortgages. We are still lending because we do DSCR loans that are based on the property itself. But most of the buyers that are buying their first house, we see also Dodge, the Department of Government Efficiency, having a lot of layoffs. So, and decrease in immigration, basically because of Trump regulations. So all of this basically will cause reduce in housing demand. On the other hand, prices might go up because of the tariffs, and basically material is going to cost more. And price pressure. Reduced demand can put downtrend, on the other hand, pressure on home prices in traditional market conditions. Variable factors: the extent of impact depends on recession severity and existing market conditions. All right, so what are the current market dynamics? So as for now, there is a tight inventory. The housing market faces significant shortage of available homes, driving sustained prices despite uncertainties. There's low mortgage rates. Many home owners locked into low rates and reluctant to sell. So basically during COVID, the rates were very, very low. A lot of buyers, a lot of owners refinance, and now they are not selling. So that's also further constraining supply, and also supply demand balance. Limited housing supply could counterbalance decreased demand during a recession. So what are the potential recession outcomes? So first of all, buyer hesitation. People are afraid. We saw that in 2008. People being afraid to get into the market. Financial insecurity. They don't know what's going to be about jobs, and may cause potential buyers to delay purchasing decisions. As for demand, there's going to be a demand reduction. Overall market demand could dip as economic uncertainty increases. Supply constraints. Limited housing inventory may prevent significant price declines. So basically, we're not expecting a huge decline in prices because there's not enough supply. And foreclosure unlikelihood. We don't expect foreclosure because without widespread job losses affecting mortgage payments, foreclosure surge is improbable. All right. So basically, if we're going to see a lot of job losses, we might come to foreclosure. But the thing is these days that basically prices increased so much that it's not like 2008 that people been underwater and if they cannot pay the mortgage, let's say they got laid off, they cannot pay the mortgage, because basically today there's a lot of equity with most properties, so they can always sell and not get into a foreclosure. So what are the expert insight? Market cooling. Economics suggest a recession might cool the housing market without dramatic price drops. Supply demand balance. The interplay between reduced demand and limited supply will determine market trajectory and mortgage rate influence. Federal Reserve policies will significantly impact buyer behavior and home affordability. So let's see the key market indicators. So this one is for inventory shortage, low mortgage locked in, buyer demand, foreclosure risk, and price decline risk. So what about regional market variation? Hot markets. Cities like Columbus remain strong despite economic concern, showing regional resilience. So you can read all of these articles on our website. Columbus is the hottest real estate market in the US. We see demographic shifts. Millennial buyers gain advantage in certain markets, affecting demand patterns. All right. Millennial home buyers now have major advantage in the housing market. And new construction. New home sales boom in some areas despite overall market slowdowns. So what are the market outlooks? Market buffer, low inventory, and homeowner financial position provide protection against drastic drops. Cooling, not crashing. A recession may cool the market without triggering significant price declines. And informed decisions. Buyer and sellers should consider economic trends and personal circumstances. All right, guys. So as we can see, there are different variations that could impact the market if we are going to get into a recession. I hope you guys enjoyed this episode. Of course, like and subscribe. If you have any comments, leave them below. What do you think going to happen in the real estate market? As for recession, do you think we are heading into a recession? Do you think the market, the property prices going to go up, going to go down? I want to hear all of that from you guys. So thank you guys for joining us, and see you in the next update.